What is up, Winning Wealthers? We got episode number 13. Brock and Jeff here. We've got an awesome interview, so we're excited to get into it. Tune in. This is episode number 13. Today we have a very special guest, our second guest on the show. He's a friend of mine, and his name's Dylan Marma. He's the principal of the Requity Group. They're a vertically integrated real estate private equity company. They've been investing for the last 5 years, and he's been the lead sponsor of over 150 million in transactions, including over 750 multifamily apartment units and 2,000 lots of manufactured housing communities and RV campgrounds. I am super pumped to have you on here, Dylan. Welcome.
Great to be here.
You know what? Like, we're just getting going on this thing, but the whole show is kind of about, the trinity of wealth, health, happiness, and the people that we're talking to, we've had Adam, we've had Tony, so it's actually the third guest, but it's guys that are, guys and gals that we're hoping to talk to that are really up and coming, but have accomplished a lot, and not only in business, but also just in life in general. And I've thought, I think the world of you, Dylan, as you probably know, we catch up from time to time, and I've been super impressed with what you've been able to build. I'll just say it for everyone out there listening, all 300 of you that hopefully we'll get. But Dylan is probably one of the smartest real estate minds that I know, and he's a young dude. I don't even know, Dylan. How old are you?
29.
29. My goodness. Brock old.
Same age, 29.
29. I'm an old fart. 34. But like I said, I'm super impressed. Really appreciative that you joined, or that you're joining the show, and would love to just, take a couple minutes and just kind of hear from you. How did you get into, how did you decide on real estate? How did you build to where you're at, just in 90 seconds or so?
Yeah, sure thing. Well, I appreciate the kind words, and hopefully I'll be able to live up to some of that during the show today. But in terms of my story, 29 now, so I guess I started real estate at you could say 20 years old. I was going to school for accounting and kind of following a traditional path growing up upstate New York. I thought I would go get my CPA and go work in New York and finance, and I just had that kind of that moment where I was reading a lot of personal development books, and I just had that moment of inspiration to say, I really want to give something a little bit more entrepreneurial a shot. And around that time, I caught the bug for real estate. I didn't know much at all, but it just seemed like a pretty overall, I guess, good risk-adjusted way to be able to build up some decent wealth for yourself. So I bought a one-way ticket to sunny San Diego to try to create this whole lifestyle by design vision that I had for myself at that time. Landed a job, really last minute. I remember running on the boardwalk with a suit on, trying to hand out resumes just to try to keep myself, on my feet out there. And thankfully enough, I was able to land a job at a real estate investing education company that was basically selling programs and education to people that wanted to learn how to flip houses or buy rentals. And eventually that company started to get a lot more into the commercial real estate space. But spent 3 years there, had a lot of good mentors, started to buy some out-of-state rental properties, and I was in sales at the time, so I feel like I learned a lot. Was able to learn sales, public speaking, and get kind of the basics of real estate. And the company itself was actually taking a little bit of a shift while I was there, and I was fortunate to be at the early stages of it, as they were really transforming and doubling down a lot of their resources into running an equity raising company for commercial real estate. So I was able to learn about the syndication model there, and I think I had just this light bulb moment where I said, look, I think this is something I can understand. I think it's something I can do, and I think it's a vehicle that would be worthy of me, committing my, the next few decades of my life towards, possibly, right? And I think it kind of satisfied the entrepreneurial bug, and so I really just sunk my teeth in. And I remember just having that moment of just, I actually talked to a few mentors at the time about the model, and just had that light bulb moment where I said, look, I'm really going to go all in with this. And not long after, I ended up doing my first commercial deal, which is a 21 unit JV deal with a few partners, actually in upstate New York, where I was initially from. And then I left my job early because I was young and had the resources to do so. And I said, I'm just going to go move out to the Southeast because that seems like there's a lot more opportunity out there. And, the multifamily market, which was my big focus at the time, was fortunate to, line up, partnership with some guys that had a really strong existing portfolio in Tennessee. And I was kind of the young sweat equity to come in and try to help, with building a process to raise money and, try to scale like the business that we were doing. So spent, 3 years working with the partners I had at the time, and really cut my teeth on multifamily. And we bought deals in Tennessee and Kentucky mainly. And then after 3 years of that, we just realized that we had different long-term visions of where we wanted to go with our futures. And again, I learned a tremendous amount at the time, and I think I kind of had a bug to. I think multifamily was a little bit tougher at the time to get super excited about, just based on, I think, I was kind of dealing with like just watching all the cap rate compression, and then I was looking around, and I had some friends that were doing really well and buying mobile home communities, and they were talking about how they're upset that they can't get 20% cash on cash. And I was at the time happy to look for like 6-7% in multifamily, right? So I said, if you can show me how to get 10, and once I understood the fundamentals in the business, I said, I think it doesn't make any sense why these things are, getting such a higher yield when you have less capex, you have less turnover risk, and so on. So, so I really kind of got that light bulb moment about the with the MH space, and that's when we started the Requity group 3 years back. And since then we've really grown a pretty big business with mobile home communities and RV campgrounds, which are somewhat similar, but there's definitely quite a bit of nuances there. We can get more into that, but then now today we have 19 properties, mainly scattered throughout the Southeast. And from day one, I've always been a really big proponent for managing in-house. So we started the management company. We invested heavily into it early on, and now we have over 60 total team members on the management side of things. Obviously, vast majority of that is just on-site team members, and we have team of regionals, in-house accounting, and things along those lines. So that's where we are today, and it's been good run so far.
So if we could step back a little bit. So you said out of college you worked for a real estate company, which I think is a great, if you know you want to get into real estate, go work for someone that already knows what they're doing, right, and learn from them. If I could go back, that's what I would do.
100%.
So your first deal, you said you were living in San Diego, you bought a property out of state. Was that just like a single family house you bought on your own, or like what was like the first deal or two you did that you were investing out of state, it sounds like?
Yeah, honestly, the first deal or two are embarrassing to look back at in retrospect, but they were turnkey rental properties through like a turnkey company, and they were in the Midwest. So I won't get too into the specifics.
Yep.
Wasn't really thrilled with the overall returns, as I think I looking back, like I didn't realize the way that some of the turnkey companies work, but I think they were somewhat being overvalued and being sold on like a cash flow model versus having like a value add piece to them. So thankfully I was able to cash flow probably 10% or so, and then like sell them back out at my initial price. But I ended up selling back for the exact same price and rolling that into a multifamily deal a couple of years later. But it was
Yeah, for sure. So okay, so you did those, and then you said at some point you pivoted over to the commercial side. And what was the thought process when you're like, all right, I'm done with single families, like I'm trying to go bigger in commercial? Like what were you thinking through when you did that?
Well, I think for me, it really latched on to the syndication model. I think at the time, I think I saw it as not only to do a deal in commercial. Of course, there's definitely clear benefits, having more doors and some more diversification in that sense. But I think for me, it was sort of a stepping stone of like, okay, well, let me learn with my own, money invested on the first deal and not bring on outside investors, and try to start to get the experience with a few JV partners and, understand the model a little bit better. And then it was almost an investment for experience. The first one is a pretty it's got a light value add piece to it, but it was a nice, kind of cash flow play that was just a good way to kind of get in the game, and we still own it today. And and that was the thought process in the first deal.
I love it. I always tell people, and sometimes investors don't love hearing this, especially, and we're kind of past that point now. But I consider, even what we were doing in real estate. So I've been doing, I started similar to that, where I was buying small, duplexes and no real value add strategy really. But like even as we kind of matured into doing bigger commercial deals and through JVs, and then started the syndication business, and we've done a number of different asset classes. I mean, I've still viewed the past decade or 8 years or whatever as like a learning lesson, right? And we're trying to just refine it and get it to the point where we're like, really dialed in. This is our core business. This is what we know well, and we're there. But I feel like nobody, no matter how much you read, and I know you read a ton, you really don't learn things until you actually go out and do it, which I think is a great lesson, for anyone out there, right?
Yeah, totally. And I think it's in the beginning. Yeah, it like you said, it can be awkward to say that to investors, because the idea of like you don't want to be learning on someone else's dime or taking unnecessary risk, but I think I think at a point investors appreciate that, or at least the right ones do, that that you're open, transparent, and you don't think you know it all. And I think that to your point before about in the beginning, it's certainly awkward to say we're learning, especially when you have other people's money invested in, right? And hopefully you have skin in the game of your own. But I think, as much as everyone wants, seems like everyone wants to be invested in these, like with the guys with the gray hair that have been, through multiple cycles and have it all figured out. I frankly don't think anyone has it all figured out. And I think that, the assets that we're investing into are dynamic, and, the things are changing tremendously, right? So like even with some of the business that we do, it's like almost like we're running, like a online, like, almost like an e-commerce style marketing in some aspects, right? And like that didn't exist 10 years ago. So I think, at the end of the day, like, the more investors can sort of, appreciate that, again, it is a learning experience, and hopefully, the sponsors that you're investing into are authentic and transparent, and being able to share that and learning lessons. I feel like that goes a long way versus just, like I feel like some have the tendency to try to like cover everything up and just like act like they have it all figured out.
I totally agree. I think it's just being upfront, being genuine, authentic, transparent with people, and investors, if they like you and they believe in your business model, and then you have some skin in the game as well, and you just look them in the eyes and say, hey, look, we don't know it all, but we're going to figure it out. We're going to be in this with you to figure it out. We've had some tough deals. We've had some really good deals. We've had some tough deals that we've had to like have some sleepless nights over and really put our heads together and figure it out. And I think that some of the things that you were saying there make a ton of sense that way. I do. You had a.
Well, I was on that too. Just kind of random thought I had was, I think especially a listener that's thinking like, well, they want to get into syndication. How do I raise money? Right? Like it's a tough thing to do, right? But I would say, similar to what you were saying, Dylan, it's like, of course, if you have the track record experience, I mean, that makes raising money much easier. But I think maybe that's only 50% of, as an investor's thinking through, should I invest in this person? I would say really the other 50% is just the person liking you, right? Like coming across as a sophisticated person and overall a guardian of their capital. I think it's relationship building at the end too, right? Like if you meet someone and you have a good relationship with them, even if you don't have all the experience, of course, that helps, but you can still get them as an investor.
If you have a solid background, you come across authentic, and you have a solid business plan, and they believe in the business plan, the asset class, and they believe in you, that you're going to figure it out. There was a ton of things that I wanted to unpack there. I mean, do you want to take it into?
Well, I was gonna go into the asset class stuff,
That's
right?
what I wanted to go into.
Yes.
Sharing a brain.
Yeah. So you started in multifamily, same as us. I think a lot of people start in that asset class because it's the most common, right? But like, what, as you were looking into like, hey, what asset class am I going into next? You landed on the RV parks. Like, what brought you to that direction? Why do you think it's the best asset class to be investing in? What's your thoughts on that?
Well, I think it started with mobile home parks, and then RV parks
Yeah, exactly. The MH was definitely the start, and then it transformed into RV after. But yeah, multifamily was the start, and I am definitely a believer in falling in love with the return profile more than falling in love with the asset class, and it's something that curses me sometimes because you get frustrated when you start seeing the return profile is shifting, which is this natural part of these cycles, but. I think with multifamily, I think getting in, initially I was eager to target, 8% plus yield. And, I like the idea of having just the margin of safety that you have, when you have a higher yield asset that still has value add potential. And, there's a lot, I think a lot of our strategy early on was targeting mom and pops. And, then I think, that became a little bit more difficult to find. It definitely still exists, and we still have some multi that we bought in the last few years. But it's I think for me my appetite for the returns that were presented in the MH space, and then shortly after the RV space, just to me it just made more sense. I don't know if I'm just I guess I'm just you consider me more of like a cash flow driven investor in some regards, but I think I definitely just get generally attracted to higher yield. I think I think having a healthier debt coverage ratio, there's something to be said about it. I think it's more resistant towards what we're going through right now with the interest rates shooting up. Doesn't have nearly the downside impact that you do there, and I like that most of the space uses more conservative leverage of mostly fixed rate 5-year loans. There's not as much bridge that you're competing up against, so. I think it was a variety of those things that got me interested. And then, at the same time, you always have to look at the underlying risk, because it's not just about the potential yield, but, in this case, like, both asset classes have, they show really consistent growth over long spans of time, and, low overall CapEx risk, which is nice in the sense that you don't have like too much money constantly needed for, just deferred maintenance issues that can take place in the properties. And, in addition to that, I think they both just show a lot of resilience with just strong occupancy levels, and in the MH space, very very long term residents, and in the RV space, just a lot of strong repeat customers.
Are you seeing a lot of institutional investors coming into the mobile home park space now too?
Crazy amounts. Yeah, it's changed dramatically since I started 3 years ago. Cap rates have went down to where right now they're lower than multifamily in quite a few markets. It's not the cash cow that it was. So it's certainly been more difficult because institutions have definitely woken up to it, and you're seeing a lot of people exiting in portfolio sales to these institutions. So we've seen tremendous cap rate compression. It's been in the last 12 to 18 months, it's been really difficult. We've only closed on one MH deal. We've been a lot more active within campgrounds as a result of it. But I would say that more recently, knock on wood, but we are starting to get a little bit closer on some deals that are making a little bit more sense to us now. So hopefully there's some price adjustment. There hasn't been. I think in MH there's been less price adjustment than most of their asset classes, but I do feel like there is a little bit of adjustment going on right now, which is starting to help us make a little bit better sense of things.
And so within when you go, so I guess for one of the things on this show that I get some feedback on a lot is we start, and it's easy to do, especially talking to someone like yourself, very sophisticated, knowledgeable, intelligent investor. We start to talk, pretty in depth about commercial real estate, syndications, and different asset classes. But if we break it down at a more fundamental level, I think you're saying that mobile home parks, you like the macroeconomic trends, occupancy rates. Housing costs are through the roof for everybody, right? Kind of drives more people into the mobile home park space, especially if you have a park that you can go in and add a ton of value to, and it's not like if you guys ever watch Trailer Park Boys, right? Like you find a show like that. That's not what Dylan has, but if you find a something in an area that is the population's growing, and maybe it's just been neglected. It's a mom and pop shop. And then you come in and you enact your value add strategy to make it beautiful. And and desirable to live in, and it's a lot more cost effective than going out and buying a house. Or it's easy to downsize in. Is that some of the things that you're talking through there?
Yeah, for sure. I mean, on the MH side of things, generally, it's not even just an alternative to an apartment. It's usually an alternative to a house for most of these people. And most residents are, people with families. They don't want shared walls. They want, front and backyard their kids can play in. And, they generally are looking for longer term home ownership, but maybe they just don't have the credit or the down payment to be able to get into traditional residential homes. So oftentimes this just makes one of the most affordable forms of home ownership, where they can buy a used home for 10 to 20,000, or they could buy a new home for 65,000 or something along those lines with the financing program. And then from there, they're just really responsible for lot rent, and that takes care of a lot of times either their utilities or the upkeep of the community, and lawn care oftentimes, and also just the professional management, right? People making sure they're living in a safe place they can call home. So the average, given that the nature of that, and the fact that they own a home, means that their monthly bill is usually about 50%, 40 to 50% of what a 1-bedroom apartment rental would cost. And these are 2 to 3 bedroom homes. So they have substantially substantially better than renting an apartment would be for them, for most people in this situation. And that because of that, they generally have a vested interest in taking care of their home, being a part of the community, and that's usually why they stay for an average of 15 to 20 years after purchasing a home. So for the ownership, you don't have nearly as much leasing and turnover that you deal with,
which is a huge cost. I mean, unit turns in multifamily, that's that's a huge benefit. Yeah, I know when I talk to you, I get excited about this asset class too. Were you gonna ask?
Well, I was just gonna say, like, something I was thinking about was, but there's so many ways to make money in real estate, right? Like, you can, hundreds of ways, maybe even thousands of ways, right? There's a lot of ways you can go in real estate. And I think when someone's starting off trying to figure out which path do I go down, it can be pretty daunting, right? Like, should I get an Airbnb? Should I get into flipping, wholesaling? Should I get syndication, right? I think it really makes sense to, as we, in our business, we've been in multiple asset classes, as Dylan's talking about, he's been in several asset classes. I think it makes most sense. You start in one, right? Like, become strong in one asset class, do a few deals there. And then you might find, okay, now I like this asset class better, and you go over to this asset class, and maybe a couple of years later you go over to this one. But I think you certainly want to start in one asset class and just do that one for a little bit of time. At least I think that makes the most sense.
You're going to know what you're looking for, I think, right? So if you're just like, hey, I'm out here looking for a deal, right? Like, it's a lot harder to find something rather than essentially knowing exactly, what's going to fit into your model and what you can get most excited about, I think, to use your term, Dylan. And then basically getting out and meeting with one thing that I thought was interesting, and I know you guys do this, but on your website, I think I've said 90% off-market deals. So how do you guys go about finding off-market deals? Like, do you have any strategies or systems, processes in place?
Yeah. So I actually put a tweet out about this morning. So I'll mention kind of some of the stats that I hit on here. But when it comes to the off-market deals, we do a lot of cold calling. We make at least 100 calls a day, 5 days a week. And generally that results in about 1 to 2 appointments per weekday with owners across the country. So we generally are, looking for people that have, that kind of fit our buy box, and we build a list of these owners, and we try to maintain good follow-up with them. But that said, though 90% of our deals are off-market, the majority of the off-market deals have been off-market through brokers. There are just so many great brokers out there, and it's inevitable that they make so many calls a day too. They're probably all making 100 calls a day each too. So it's a lot of brokers and other owners that are doing the same thing that we do, calling different ownership groups and then referring it to us off-market, right? So that's actually where the bulk of our off-market deals have come from, though our direct marketing is a huge priority for us, and we found some tremendous deals there. The bulk is through brokers. So the stats that I was referencing earlier was, it looks like our on-market deal, we've only done 4 on-market deals, throughout I've only done 4 in the last 6 years, I guess I should say, out of doing like 26 transactions or something like that. 4 of the 26 have been on the market. And I would say if I had to guesstimate, we underwrite a ton of deals. So we probably one deal for every 200 that we underwrite ends up getting somewhere for the on-market deals. So you would question, is it even worth your time, or why do you even look at on-market deals anymore if your conversion rate is 200 to 1 when our off-market conversion rate is probably 50 to 1. But the reason is because just by keeping active, working with the brokers and showing that we're an active buyer and we're giving them feedback on the on-market stuff, that usually opens up doors for them to think of us, first in mind. So when they go to shop something off-market, we come to mind, and they can, we have the reputation with them where they know that we're serious buyers and ready to close when the right opportunity comes.
I agree with all that.
Yeah.
So let's go back a little bit. I know we're jumping around a bit, but so one thing that is super interesting to me is just the value add strategies throughout different asset classes. And so within mobile home parks, like when you guys identify a park that you like, or the RV campgrounds, and I'm sure they're similar, but I'd love to understand kind of what are the top things you hit on to really change the look and feel, the brand, and ultimately the net operating income and cash flow of the properties. What's your
Yeah, I'll hit on both of them in a nutshell, because they actually can be quite a bit different as you get into it. But the MH communities that we serve, again, these are residents and are oftentimes they're not getting treated with the level of quality, professionalism, service, and care that you might see in even a B or C class apartment, right, with a professional management company in place. So you're dealing with people that have been dealing with a lot of times mom and pop ownership groups, and some of them are great, of course, but then some of them we've seen just like some people being like severely mistreated, or they're not screening their tenant, they're not screening any of their prospective tenants. So like they're having people that have just bad records moving into their backyards, or drug dealers in the communities and things along those lines, right? So I think the main way that we add value in those sort of communities is we bring in the professional systems. We start, making sure people feel heard, they feel listened to. The proper renovations are given to the homes that we would own in the community if we own some of the homes, and then we help with non-renewing or evicting anyone that is not up to the standard of living that we're shooting for, making it all around a safer place. Oftentimes we also pave the roads if they're not already paved. We try to add lighting, things along those lines, right? We try to do events like back to school events where we give out school supplies and different holiday events throughout the year. And I think it's more of the sense of community that we try to bring in. It's probably the number one value add across the board for the MH world. Now, on the RV side of things, RV presents a little bit more of a hospitality business without getting too into it. But you have some that treat their RV like a second home, and then you also have some that are just visiting for short-term stays. And we do have some that, of course, live in their RV full-time, which is becoming more and more popular. But it is, generally speaking, more of a hospitality-geared business. So oftentimes one of the big value adds from an ownership perspective is just bringing them online. They might not have a website, or it might be a really old website with clip art from like 1990s on the homepage. So by us being able to go in and put more modern website in place, get online booking in place, and also running Google and Facebook ads and different SEO campaigns to be able to build up the online presence and build up a stronger Facebook page. And I think our team does a lot of TikToks and things like that now to get the word out. I think it really helps with just developing like the branding and the marketing needed to be able to get the word out for the campground itself. Then past that, it's the guest events, doing at least one event per month, but some are much more frequent than that. On the campgrounds, so holding guest events, especially if you're buying off a campground owner that's a little bit burnt out after decades of running the place. They might have stopped doing events and stopped trying to pour in for the community. So we come in and help reinvigorate it with more events. We bring in a pretty healthy improvement budget usually to help with like adding more amenities for people, like done gem mining, we've done mini golf, we've done upgraded the pool areas. We're adding a sports lounge to one. We have arcades in a bunch. We have kayak rentals, dog parks. It's all about just pouring in and creating nice things for people to do while they're there, creating memories for the time that they're there. So you can start to see how it ends up being a little bit of a different business in that sense in terms of the overall value add strategy. But that's definitely a big thing, is trying to just really push to create great experiences, try to push for lots of 5-star reviews, and just build up the reputation online for each of these companies.
I love it. What questions you got about RV parks? I want to start looking for these things now.
Yeah, I mean, I keep hearing more and more great things about the space. I mean, it's one of the asset classes we haven't really explored or done yet, but like I was going back to though too, it's also like it's easy to get the shiny with any business, right? The shiny object stuff where it's like, oh, a different real estate asset class or crypto or NFTs. It's like very easy to get. So it's like I do think there's something to be said about like, all right, just stay in your lane and like focus on what.
Yeah, we just don't have the. I mean, we don't have the team or anything in place to be able to go and have that sort of hospitality mindset. But that's so cool. And as you think about like everything coming online these days, and you find these parks that have a super outdated website and they're not doing like fun events and stuff. It's like taking the Airbnb model and doing it at scale, and I love it, man. But
it's much easier than Airbnb. I'll admit that, and I'm not saying it's easy, because it is a lot of hard work. I've talked to plenty of people that have gotten into a campground and dreaded it because of how much work it ended up being. So we've been fortunate to have a good team, but I still think it's admittedly easier than Airbnb. We have about 40 short-term rentals scattered throughout our portfolio, so we have a ton of experience with it. But just the fact that you're taking out the cleaner aspect and having to manage all the cleaners and deal with all the deferred maintenance, like leaks and all kinds of stuff that takes place when you have the physical structure. I've personally found it to be much easier in that sense, and even like just staying competitive on Airbnb listings is a lot of work. I mean, it can be tough. So like I've definitely come to the conclusion that I prefer the short-term rental aspect of RVs over your typical STR model today.
Such a cool niche. What if we zoom out a little bit and talk about? Sounds like, you're a lot of real estate people are just out looking for real estate deals, as opposed to building an actual business and building a company. All over your website, you guys talk about company values. Where do you why don't you walk us through, your approach to building this business? You said 60 employees over the last 3 years. That's huge growth. How do you go about building that culture, hiring people, and your overall company vision strategy?
Yeah, I mean, the people is the hardest part probably to what we do, right? And getting the people right is crucial to being effective in operations and what we do. So I'll just hit on a few things that have been helpful for us. So though of course we're always trying to figure it out. We do a weekly kickoff call with the the MH team and the RV team every Monday, and we cover wins from the week. We do core values shout outs for standout team members, and we cover a lot of our core KPIs in terms of either collections or occupancy or number of calls, call answer rate, total bookings, forecasted revenue, things along those lines. So we cover those all on a weekly call, where we have all of our managers on those calls. And that I think is really helpful for us setting the tone and also being able to keep a pulse on things. We have what we call the pulse report, where we review that. Then, then in addition to that, the managers often have additional huddles throughout the week with the regional managers as time goes on, both as groups, and they also have either weekly or bi-weekly one-on-ones, generally weekly with their respective regional managers. So we have 3 regional managers that manage all of the managers. And then we use Slack I feel like most people use Slack these days, but we use Slack, and that's tremendous help for us with being able to kind of streamline our communications and help with company culture. We're constantly, we have all kinds of channels for like shout outs for great reviews that are coming in, or pictures of the CapEx projects, pictures of the events taking place, and just kind of helps build a community, because a lot of our properties are a bit remote. So we have to try to use technology to kind of keep us close together and help us keep track of everything going on all at once. But that tends to be really helpful. And then in terms of the culture, I mean, it's really I'm constantly trying to think about how do we make everyone's job easier. And how do we try to, of course, we have metrics to hit. We have, things to, things that are crucial for us as a company, but we're constantly trying to think about how do we not overload the managers and not make things too bureaucratic. And we want to stay lean, stay nimble as best we can, and have clear a clear idea of who makes the decisions and which decisions should be made on site, which should be made off site. And I think we've also built a pretty substantial back office overseas to be able to help with everything from guest communications to inbound calls to all of our back end accounting to filling out most of our reports that need to be filled out and things like that. So that's really helped kind of lighten the load for a lot of our, core team members. And I think as a result of all of that, we've hopefully been able to, create an overall good work environment. We had good retention rates from those that are there, and we offer, 401k and health benefits, and we try to, just create, good place where people can consider to be like a career when they come to work with us.
I love it.
Yeah, systems and processes.
Beast mode.
That's awesome. I had a question. So the syndications versus fund model. So just to explain quickly for listeners, so syndications, you're going out and buying one property, you're going to go out and raise money for that property, and that's the deal you're doing. Whereas with a fund, you could go out and raise $5 million and take that capital and deploy it into 5 or 10 different deals. So it's kind of the trajectory usually is you do syndication deals and you go into the fund model. That's the normal trajectory you normally see in trajectory we're going through right now at Smart Asset Capital. So my understanding is currently you're operating on the fund model. Is that right, Dylan?
We actually did 2 smaller funds that were 10 million each, and we did one that was like a specified asset fund in addition to that. And we are right now running deal by deal, more syndication model. You consider it for the time being, just because it's really not. It's been a tough market, and I don't want to really have capital sitting there that I have to constantly report to and tell them that we don't have much to deploy into right now. So we're running deal by deal, and I think my expectation is we likely will continue to run deal by deal for the foreseeable future. And I can certainly get into reasons why I'm not.
I'd be curious to know the reasons why.
Yeah. So I think funds definitely serve a place in the market. Funds bring, more diversification. In some ways, it certainly reduces risk for investors because you have, usually your promote is based on the fund level performance. So, the collective, all of the assets in the fund, or you have to hit a certain measurement before you tap into the promote. So versus it being on a deal specific level. So I think that benefits the investor surely. But I think funds are most attractive. I think it's more of like a timing thing, and it has to do with a blend of both the check sizes that you're dealing with and the timing of, the opportunity set, we'll call it. I think when we launched, our first funds, we just saw enough of a pipeline where we said, this probably is not going to last, and we want to move quickly, and we're probably going after smaller assets that would be a lot of effort to raise individual deals one at a time. So the fund model made sense for us. However, I think now as we're thinking about what's the most effective way for us to scale and continue to pour into the properties at the level of the level that we would like to be able to continue to uphold our operational standards to. We're leaning more towards larger assets for the most part, still small in the grand scheme, but we're not really pursuing many deals that are sub 5 million anymore, for instance, right? So because of that, we think that for us, it probably makes more sense to just go deal by deal. And, I think I value sort of the flexibility and not necessarily, having capital that, is constantly looking to be placed. So I think just going deal by deal kind of takes that pressure off and allows us to, kind of have a little bit more of a flexible strategy too, just because, things, as you can see, we are a bit entrepreneurial, right? We have kind of ventured into a few different types of assets, whereas I think a fund is best if you're really clear cut on this is our strategy, this is exactly what we're buying, this is our buy box, and this is what we're going to do. But I don't see a strategy that at the strategy we're pursuing right now, I don't see enough of a pipeline where I could say, yeah, we can comfortably raise 50 million or whatever the number might be and go put it to work, and hit a return profile that I would deem to be like really attractive to investors. So it's just not in the cards right now.
Makes a ton of sense to me.
Yeah, that is an interesting way to. Yeah, because with the fund, I mean, you're in a box essentially, right? Like you say you're going to buy this asset class, and they raise the money, and all of a sudden, this great multifamily deals pops up. From my understanding, unless you structured it the right way, you can't go pursue that deal. Where deal by deal, but I guess usually the premise is you're going after this, and you have to deploy the capital into this. Whereas with
and what if the market changes, right? You set everyone's expectations that you're targeting a 16, 17 IRR or whatever it might be, and now the market is, the rest of the market's valuing those assets at 15, and now you have to resort to really trying to roll up your sleeves and find some like heavily discounted off-market deals, but that might just not be practical to deploy depending on how much total capital you have to place.
So what are the deals that you're looking for now? Like, what is your quote-unquote buy box? What are you guys looking at? You seem like super nimble, very entrepreneurial, very quick to adapt to market changes. There's been a shit ton of changes, namely interest rates doubling over the last couple of years. That's the big one. What is it that you're looking for right now?
So right now we're primarily targeting 100 plus lots on MH or RV. RV, we really lean closer to the 150 to 200 plus. That would be strongly preferable to us, just given that it costs more to run them and you get better economies of scale as you go bigger. Whereas MH is certainly manageable at 100, or you could even go down to 50 and still probably have similar economics. But the buy box is mainly 100 plus lots, mainly Southeast. We do have one in Kentucky, one in Indiana, and we are starting to eye some of the Midwest markets, especially on the RV side, as they seem to continue to have pretty strong demand and good overall attractive returns. So, but we're mainly Southeast focused, and we're usually looking for something that we, the MH side, I would say average, say 8% yield over 5 years. It could start lower, whereas the RV side, we're probably trying to average closer to at least 10. Maybe if it's more long-term focused, it might be a little bit lower. If it's more short-term, probably a little bit higher. But so yeah, bit higher yields on the RV side certainly. And then our bread and butter strategy has always been to go in and add value. And once the value add plan is executed, we like the idea of refinancing to be able to return a lot of the investor capital and then continuing to hold long term. And a lot of our investors, being that's what we started off with, we've attracted a great base of investors that all have similar appetite for that same sort of model. And a lot of our investors benefit from the tax advantages because these tend to have better losses than most types of real estate do. So it really helps play into their tax strategy too, to be able to collect the depreciation and then also continue to hold and not have to pay cap gains.
I love it. So where do you see the Requity Group in 5 years from now? If you had to look out, or pick 3 years or 10 years, I don't know if you have any. I don't know how you guys set goals or if.
I really don't have a strong vision on how many total deals we'll have, right? Starting off, we had some goals on number of units, number of lots, and how much we want to do each year. But I frankly just want to just do as much as I can with whatever the market hands us, right? If the market opened up and pricing was really attractive tomorrow, maybe we want to go out and try to buy 20 deals next year, right? Maybe it's in the cards. But if we do 2 deals next year because that's all the market's gonna give us at the time for the returns we're looking for, then so be it, right? So I've started to get away from setting goals, for better or for worse, when it comes to like volume goals, and we're really just kind of looking for organic growth, and just trying to stay disciplined with making sure we're seeing as many deals as we can, keeping our relationships strong, keeping up with the off market deal sourcing, and then I would imagine we'll have like spurts of more intense growth than in some years versus other years, and just kind of see where that what that builds, where it leads us, kind of thing.
Just riding the market wave intelligently, predictable growth. I love that. So do you have goals that you set for like those pulse reports that you guys do, and like kind of weekly operational goals or quarterly operational goals?
Yeah, we're super strict on our budgets, and I don't know if strict is the right word, but like we're super disciplined with like constantly measuring up against the budgets that we have for the property level goals. So without a doubt, we every year right now we're setting all of our budgets right now. We'll have them all complete by end of October, to set the next year's targets in terms of our income goals, NOI goals, and things along those lines. So that's what we do a lot more constant review of, as each week we're measuring up against our income goals, and then at the end of each month we do like a deep dive with all the regionals to kind of walk through every single property and nitpick all the expenses and kind of make sure everything's being allocated properly, and make sure we're on track to our targets. And we also do quarterly rocks, following the kind of the EOS model, where we set property level rocks, where we have usually maybe three or so different rocks per property per quarter of some of the major action items that will move the needle forward the most. So that's definitely been a big priority for us. So yeah, if anything, that's where a lot of our goals are, is like the entity levels, the business levels themselves. And then like when it comes to my philosophy around building the company itself, I definitely had a huge shift over time as we've gotten into this, right? Like I think at one point I probably had more of a vision of like, let me build out a really big wide team, and that's going to lead to more opportunities. And I realized that generally it's the market that is the bigger bottleneck on the opportunities, not the size of your team. So we really, in the last year, we really just focused on running more lean as a team, and just sort of letting our growth be more predicated on kind of where the market takes us. And I don't know, to me that's been a pretty sound strategy. I like to listen to like Warren Buffett or read a lot of his stuff, and like if you talk about his the growth strategy or the for acquisitions with Berkshire, I think he describes it as like a haphazard strategy for acquisitions, where it's really just like taking it as it comes and seeing what happens, versus like having to feel like we have to hit a certain amount in fees just to like feed a big team or something like that. So yeah.
I completely agree. It's funny. I mean, the show is called Winning Wealth, but Warren Buffett comes up on every single episode now. 13 strong. Usually I'm quoting him, but I like that you brought it up there too. Absolutely. I mean, so I think this has been great. Every time I talk to you, dude, I'm like, it's total beast mode.
Yeah.
Do you have any final questions for the man himself, or?
No, yeah, I think we went through a lot. I mean, I agree. Jeff's always talked highly of you, and we met briefly a couple of years back, but it was awesome going through and learning more about your business and kind of where everything's going. So we'll definitely do another one in a couple of years. We're at $1 billion assets under management, and hear the full story.
And it's on the goal. It's
not the goal,
timeline, but it definitely is it's a goal at some point.
Oh yeah, absolutely.
I love it, man.
Sweet. Well, where can people, follow you on social media, or if people wanted to reach out and learn more about investing with you, where can people get in contact?
Yeah, sure thing. So you could always visit therequitygroup.com if you want to opt in there and set up a call. Happy to connect with anybody interested. And also you can follow me on LinkedIn, and I've been more active recently on Twitter as well. So happy to plug in and connect on any of those.
Love it. You're the man, dude.
Thanks for listening. Episode 13 of the podcast. I enjoyed that conversation we had with Dylan. I think he's super sharp investor and really just understands business and how to grow. It was interesting to hear his story of how he went from buying a couple of units into multifamily and then found his path in the RV manufactured home space. I enjoyed it. I think it was a lot to take away from there, and really provided a blueprint for a lot of people how they could grow their business from starting small and going big. So thanks for listening.